Welcome back to the Deep Dive. Today we are breaking down the Q3 2025 results for Kimbell Royalty Partners, that's ticker KRP. The numbers dropped back on November 6th, and, well, this is a really critical one. It sort of captures this moment of real tension in the royalty space.
It absolutely does. With KRP, the story isn't so simple anymore. We have to figure out if their operational execution, which is frankly extraordinary, is strong enough to overcome the financial pain points they're dealing with right now.
Right. It's this classic battle. You've got amazing long-term assets versus some pretty tough short-term capital decisions.
And the whole deep dive today is about figuring out which one of those the market is actually paying attention to.
Okay, so let's start with that top-line snapshot, because the numbers themselves are a little confusing. They seem to point in different directions.
They really do.
So total revenues came in at $80.6 million. It's actually down 3.8% year over year. And GAAP EPS was $0.06 per unit. Also down from $8.22 this year ago. On the surface, that looks soft.
It looks soft, but that GAAP number, especially for a royalty trust, it can be really deceptive. For us, the real story here is the beat. That $1.19 figure was a colossal surprise to Wall Street.
A surprise how?
Well, the consensus expectations were way, way lower, clustered somewhere between, say, 11 and 15 cents. So depending on which analyst you were following, KRP beat expectations by anywhere from 40 to 70%.
40 to 70%. That's a staggering beat. That should have sent the stock flying.
It should have, but it didn't. And that's the tell. If you look at the immediate market reaction, it was so muted.
Muted is an understatement. Their adjusted EBITDA, which is how we really measure profitability here, was $62.3 million, pretty much flat year over year. And the stock closed the day up just 4 cents on low volume.
Exactly. And that reaction tells you everything. No one was repositioning based on the earnings beat. Investors basically said, okay, great operations, but they were completely preoccupied with something else.
And in fact, the stock has actually drifted lower since the call.
Which proves the point. Broader financial concerns, not the operational wins, are driving the entire narrative right now.
All right, let's pivot directly into those financial pressures then, because this is where all the market's anxiety is. We're talking about the distribution.
The distribution, yes.
KRP declared $1.35 per unit distribution for Q3. And you really have to look at the trend here because it's been a very rapid step down.
A very rapid one.
They paid $0.47 in Q1, then $0.38 in Q2, and now we're at 35 cents.
And this is the core of their capital allocation strategy.
Yeah.
Management spent a lot of time on the call explaining this was a deliberate choice. It wasn't forced on them.
So what's the goal?
It's twofold. First, they want to maintain a really compelling, double-digit yield. It's still running at about 10.7% annualized.
Which is still very high.
Very high. But second, and this is the key part, they're aggressively prioritizing paying down debt. They set up a really clear framework. 75% of their cash available for distribution goes to the payout. The other 25%,
the rest of it,
the entire rest of it, which was about $12.6 million this quarter, went directly to paying down their secured revolving credit facility.
So these cuts aren't about a lack of cash flow. They're about paying down the credit card after that big shopping spree earlier this year.
That's the perfect way to put it. It's all tied to that huge Midland Basin acquisition.
Which brings up a good question. That deal was around $230 million. If it was so great, why not just fund it with equity? Why use debt and then force 3 straight quarters of distribution cuts that are obviously scaring away income investors?
That's a sharp question. And management sort of implicitly addressed it. They clearly decided that the long-term quality of that asset outweighed the short-term pain. They chose to use debt to juice the returns, betting they could pay it down fast. They just felt the asset was too good to pass up.
Okay, so give us the hard numbers on that debt. Where does the balance sheet stand right now?
At the end of Q3, their leverage ratio, so that's net debt to their trailing 12 months, adjusted EBITDA was about 1.6 times.
1.6x. In the energy sector, that's acceptable, but it's not great.
It's acceptable, but it's high enough that you have to pay immediate attention to it, which is exactly what they're doing.
Yeah.
That 75-25 split is all about getting that number down fast. They're sacrificing yield today for balance sheet health tomorrow.
But on the cost side, they're disciplined.
Oh, incredibly disciplined. Cash G&A was only $5.9 million. That works out to a very competitive $2.51 per barrel of oil equivalent. They are absolutely running a tight ship when it comes to internal costs.
Okay, so let's move away from the pressure cooker of the financials and talk about the operations story. Because this is where KRP is just, well, firing on all cylinders.
They truly are. The operational data is just incredibly strong across the board. Run rate daily production averaged 25,530 barrels of oil equivalent per day.
That's a big number.
It's a huge number. That's a robust 7% increase year over year.
Yeah.
And it also handily beat the midpoint of their own guidance. But what really impressed analysts was the organic growth. Production actually went up about 1% just from Q2 to Q3.
And that sequential organic growth, that's the holy grail for a royalty business, right? It proves the model is working.
It's the ultimate indicator. Management calls it the royalty toll booth model, and that's exactly what it is.
Explain that a bit.
They own tiny little interests in over 17 million gross acres and more than 131,000 wells, mostly in the Permian. So they get all the revenue upside when an operator drills, but they don't have to spend a single dime on CapEx. It's asset light by design.
And the market share data really backs up how good their acreage is. They said 86 rigs were active on their land during the quarter.
86 rigs. And you have to put that number in context. That represents a massive 16% market share of the entire U.S. land rig count.
16%.
Think about that. The overall U.S. rig count is down significantly since 2022. But KRP's footprint is basically the landlord of choice for the most active drillers. That is a massive competitive advantage.
And all that stability is why they reaffirmed their 2025 guidance, right? Targeting around 25,500 barrels a day.
Exactly. They have incredible line-of-sight confidence even looking out into 2026.
Well, what gives them that confidence, especially if the broader rig count stays soft?
This is where we get into a really kind of nuanced part of the Q&A on the call. It was all about their inventory of DUCs.
Drilled but uncompleted wells.
Right. DUCs and permits. The key takeaway was a discussion around their maintenance level. So that's the number of new wells they need just to keep production flat against natural declines.
Okay.
Management said their current maintenance level, which they conservatively set at 6.5 wells, is probably going to be revised downward.
And why is revising it downward so important?
It's all about efficiency. It means operators are getting more oil and gas out of every new well they drill. So if you only need, say, 5 new wells instead of 6.5 to stay flat, your entire backlog of DUCs and permits suddenly lasts much, much longer. It creates this huge buffer and gives you confidence in stable production well into 2026, no matter what the rig count does in the short term.
That is a fantastic insight. It's like finding extra inventory you didn't know you had. They also mentioned their geographic diversification was paying off.
Yes, specifically outside the Permian. They were asked about it, and management confirmed that the Midcontinent and the Haynesville Basin showed real resilience. Having that meaningful exposure to gas-centric plays gives them a crucial balance. They're getting a nice boost from areas geared toward future strength in natural gas.
Okay, let's synthesize this. We have a company with amazing operational stability, organic growth, a high double-digit yield, and yet the market has just consistently punished the stock. Why the huge underperformance?
This is the absolute crux of it. Despite all the wins, KRP has been a huge laggard. Over the last year, KRP is down about 20.1% on a price-only basis. You compare that to the broader E&P ETF XOP, which was only down about 10.6%.
A massive gap. So where's the analyst community on this? Are they split?
Dramatically split. One camp sees these distribution cuts as just temporary, financial prudence. They focus on the durable, asset-light model and that long-term yield. They think the stock will re-rate higher once the debt is paid down.
And the other camp?
The other camp is very cautious. They point directly at the declining gap EPS, the distribution cuts, and, importantly, the rising unit count from M&A. They see it as a potential structural flaw. It's classic yield investor panic. They see a cut, they hit the sell button, period.
Looking ahead, how do they plan to grow? Are they just going to buy their way out of this?
Management was very clear on future M&A. They said the bar for any new deals is, and I quote, extremely high. They are not interested in the small ground game stuff. They're only looking at large, highly accretive, de-risked portfolios, like the one they just bought. Future growth will be very, very selective.
Extreme discipline. Okay, that's a perfect transition. Let's move into our segment where we take all this data and channel our inner hedge fund analyst for an outrageous but plausible trade idea.
Absolutely. And as always, to everyone listening, this is purely for informational and entertainment purposes. We are not registered financial advisors. This is not financial advice. Please do your own homework.
Disclaimer noted. Okay, based on everything, the operational strength being totally overlooked because of financial fear. What's the trade?
All right, we'll call this one the yield stabilization trade. So KRP is trading around $13.16 right now, but the consensus street price target is still way up near $17. The market is fixated, I mean completely fixated, on the distribution cut. They are ignoring the production stability and the massive competitive advantage of that 16% rig share.
So the trade is designed to capitalize on the market looking in the rearview mirror. How do you structure it?
The idea is to go long KRP common units, but you pair that with selling out-of-the-money puts. For example, something like an $11 strike, maybe 6 months out.
Okay, walk me through the logic there. Why that structure?
The market is pricing in the fear of another distribution cut or, some kind of production decline. That's why the stock has been so weak. This trade basically leverages management's own words, their explicit commitment to that 7/5/25 payout and their reaffirmed guidance.
You're betting that they'll stick to their plan.
Exactly. If the distribution just stabilizes around this $1.35 level, which the call strongly suggested is the new floor, well, eventually, income investors will come back. The unit price should then re-rate higher, moving back toward that $15 to $17 range as the debt concerns fade. And selling that put gives you immediate income, it lowers your cost basis, and you're betting against a catastrophic failure that the market seems to be afraid of.
It's a calculated bet on stability. I like it. So to wrap this all up, the key tension here is that incredible operational resilience, the organic growth, the rig share, versus the very real financial pressure of paying down that debt.
And let me just leave you with one final thought, building on their comments about diversification. Given KRP's big position in the Haynesville and the Midcon, management admitted their internal models are often conservative on long-term gas prices. So if that bullish macro story for natural gas actually plays out over the next few years, how much unquantifiable upside is just sitting there in the KRP portfolio? That natural gas optionality might be the real long-term wildcard for growth here.
A great question to ponder. Thank you for tuning in to this deep dive, and we'll catch you next time.